The chop zone indicator is a technical analysis tool used by traders to identify market conditions. It helps distinguish between two primary market conditions: choppy markets, where price moves sideways with little direction, and trending markets, where price moves consistently in one direction. The chop zone indicator typically oscillates between values of -100 and +100. Readings near zero indicate choppy or sideways markets with inefficient price movement. As readings move toward the extremes, they suggest trending conditions with more efficient price movement. The indicator measures the efficiency of price movement by comparing the distance traveled by price to the volatility during a specific period. Trading in choppy markets often requires different strategies than trading in trending markets, making this indicator valuable for adapting your approach. Understanding the chop zone indicator helps traders identify optimal market conditions for their specific trading strategies. The chop zone indicator provides readings that help traders identify market conditions. Readings near zero, typically between -30 and +30, indicate choppy sideways markets. In these conditions, trading ranges dominate, making breakout strategies less effective. Values approaching -100 or +100 suggest strong trending conditions. In trending markets, directional strategies like trend following tend to work better. The transition between choppy and trending zones often signals potential changes in market behavior. Let's review the key points for interpreting chop zone readings. Readings between -30 and +30 indicate choppy, range-bound markets. Values near -100 or +100 suggest strong trending conditions. Transitions between zones can signal potential changes in market behavior. Traders should look for sustained moves outside the chop zone rather than brief fluctuations, as these provide more reliable signals. To set up the chop zone indicator on your trading platform, you'll first need to locate it in your platform's interface. Navigate to the Indicators or Studies section, where it may be listed as Choppiness Index or CHOP. The primary parameter to configure is the lookback period, which typically ranges between 14 and 45 days. Many traders also add horizontal reference lines at +30 and -30 to clearly mark the boundaries of the chop zone. When selecting a lookback period, you need to consider the trade-off between responsiveness and smoothness. Shorter periods, between 14 and 20 days, make the indicator more responsive to price changes, but this comes with more false signals. Longer periods between 30 and 45 days provide smoother readings with fewer false signals, but they may lag behind current market conditions. Adding reference lines at +30 and -30 helps you easily identify when the market enters or exits the chop zone. These reference lines create a visual boundary. When the indicator moves between these lines, markets are choppy. When it moves outside them, markets are trending. As a best practice, start with the default period of 14 days and adjust based on your trading time frame. Shorter time frames may benefit from shorter look-back periods. Trading in choppy markets requires specific strategies that work when the chop zone indicator shows readings near zero. In these conditions, the market moves sideways with no clear trend, bouncing between support and resistance levels. Here are 5 effective strategies for trading in choppy markets. Mean reversion strategies work well in choppy markets. The basic concept is to buy near support and sell near resistance, anticipating that prices will return to their average. Oscillator indicators like RSI and stochastic work exceptionally well in range-bound markets. They help identify overbought and oversold conditions, providing clear buy and sell signals. Proper position sizing and risk management are critical in choppy markets. Since sustained directional moves are less likely, it's wise to reduce position sizes and set tighter stop losses. Option strategies that profit from limited price movement are ideal for choppy markets. Iron condors and butterfly spreads allow traders to generate income when prices remain within a defined range. By applying these strategies in choppy market conditions, you can maintain profitability while minimizing risk when directional trading becomes challenging. When the chop zone indicator moves toward extreme values beyond positive or negative 30, it's time to implement trend following strategies. Markets transitioning from choppy to trending conditions offer significant trading opportunities as directional momentum builds. 5 key trend following strategies become effective when markets shift from choppy to trending conditions. Breakout trading capitalizes on price moving beyond established support or resistance levels. Look for consolidation patterns where price is contained within a range. Enter trades when price convincingly breaks above resistance or below support. This signals the beginning of a potential trend. Use momentum indicators like MACD or ADX to confirm trend strength. These tools help validate that the breakout is supported by underlying momentum. When the MACD line crosses above its signal line during an uptrend, this confirms bullish momentum. Similarly, ADX readings above 25 indicate a strong trend is developing. Trailing stops are essential for managing trend trades. Unlike fixed stops, trailing stops move with the price, allowing you to protect profits while giving the trend room to develop. As the price advances, raise your stop loss to lock in profits. Common methods include using a percentage of price movement or a multiple of average true range. Moving average crossovers become significantly more effective when markets are trending. The most common strategy is to watch for a shorter-term moving average crossing above or below a longer-term moving average. A bullish signal occurs when the shorter MA crosses above the longer MA. Popular combinations include the 20 and 50-day moving averages for intermediate trends, or the 50 and 200-day moving averages for longer-term trends. Position sizing can be optimized based on the strength of the trend. The chop zone indicator offers valuable guidance on when to increase or decrease your trade size. As the chop zone indicator moves further into trending territory beyond plus or minus 40, you can confidently increase position sizes from 1 to 2% risk per trade. Always adjust position size based on risk percentage rather than fixed amounts. To summarize trading strategies for trending markets, look for breakouts from consolidation patterns, confirm with momentum indicators, protect profits with trailing stops, utilize moving average crossovers, and optimize position sizing based on trend strength. The chop zone indicator becomes substantially more powerful when combined with complementary indicators. Combining multiple indicators allows for confirmation of signals, reduces false signals, and provides a more complete analysis of market conditions. When combining the chop zone indicator with ADX, you can confirm the strength of a trend. When the chop zone reading falls below 38.2, indicating a trending market, a high ADX value above 25 confirms that the trend is strong. In choppy markets where the chop zone reading is above 61.8, oscillators like RSI and stochastic are invaluable. When the market is range-bound, these oscillators help identify overbought and oversold conditions for short-term reversal trades. Volume indicators are essential for validating breakouts from choppy periods. When the chop zone reading begins to decrease and is accompanied by a significant increase in volume, it often signals a genuine breakout and the start of a new trend. Support and resistance levels are particularly effective when combined with the chop zone indicator. In highly choppy markets, these levels define the boundaries of the trading range. When price approaches support or resistance with a high chop zone reading, it often presents good opportunities for reversal trades. Taking a multi-indicator approach creates a more robust trading system than using the chop zone indicator alone. Each indicator serves a specific purpose, compensating for the limitations of others. This integrated approach leads to better trading decisions and adapts to changing market conditions. By strategically combining the chop zone indicator with complementary technical tools, you can create a more complete trading approach that works across different market conditions. Advanced traders can customize the chop zone indicator and explore alternatives to enhance their trading approach. The chop zone indicator can be customized in several ways to better suit your trading style. You can adjust the calculation period from the default of 14, modify threshold levels from the standard 38.2 and 61.8, and apply additional volatility filters. Changing these parameters affects how the indicator behaves and can be optimized for specific markets or timeframes. Let's explore alternatives to the chop zone indicator, each with unique characteristics and applications. The average directional index, or ADX, measures trend strength on a scale from 0 to 100. Values above 25 indicate a strong trend. Unlike the chop zone, ADX measures only strength, not direction. Bollinger Band width measures volatility expansion and contraction. Narrow bands suggest a potential breakout, while wide bands indicate high volatility periods. The Market Facilitation Index incorporates volume data to measure market efficiency and is typically color-coded for easier interpretation. When comparing these indicators, each has specific strengths and limitations. The chop zone excels at identifying ranging markets but may lag during transitions. ADX confirms trends effectively but can give false signals in ranges. Bollinger Band width tracks volatility cycles without directional bias, while the Market Facilitation Index incorporates volume but has a more complex calculation. When selecting the right indicator for your trading, consider these tips. Test multiple indicators in your specific market. Consider combining complementary indicators for confirmation. Validate your approach across different time frames and adjust parameters to match your trading style.